Good morning, everyone. We're at 11:03. I think we'll get underway. My name's Lanny McGinnis. I'm President and CEO of the Manitoba Home Builders Association, and thank you for all those who are attending today's webinar. We're really excited to have today's speaker with us. But just before we get underway, and as those who are joining now, we'll get a bit of a format lesson and kind of a walkthrough in terms of today's session from Michelle Pocket from the RBC. Thank you, Michelle, for web hosting today's event for us. And I'd like to ask you if you could just walk us through today's platform and the Q&A portion of today's session. Thanks.
Absolutely. Thanks so much for having me. So today we are going to hear from Robert Hogue, one of our chief economists here at RBC. He's a fantastic speaker, so you're in for a treat. Today's platform, of course, we are using WebEx. What you will notice is you cannot see the other attendees and can only see the panelists. Also within the chat, you can only communicate with the panelists. However, we are going to use for the Q&A portion Slido, and I had the URL up just a moment ago. I will put it up once it comes time for our Q&A portion as well. And you'll be able to simply go online on the slido.com with passcode RBC123 and ask your questions at the end of the presentation. So again, you also have been placed on mute, so you will not be able to verbally ask any questions. And I think that's it, Lanny.
Great, thanks, Michelle. So let's kick off today's session, and I'll introduce our feature speaker today. Robert Hogue, senior economist at RBC, is a member of the Macroeconomic and Regional Analysis Group with RBC Economics Research. He's responsible for providing an analysis and forecast for the Canadian housing market and for the provincial economies. His publications include Housing Trends and Affordability, Provincial Outlook, and Provincial Budget Commentaries. In his functions, he is frequently called to comment on the economy, both internally within RBC and externally with clients and the media. Mr. Hogue joined RBC in May 2008 after spending 15 years with another Canadian financial institution as a senior economist specializing in industrial analysis. At the outset of his career, he spent 4 years as an economist with Ontario Hydro, where he specialized in industrial and macroeconomic analysis. Mr. Hogue holds a master's degree in economics from Queen's University and a bachelor's degree from the University of Montreal. So without further ado, thank you, Robert, and the stage is yours.
All right, thank you. Thanks, Lanny, and hi, everyone. It's a great pleasure to be talking to you, and I'm very appreciative of you taking the time to listen to an economist. I was mentioning earlier to Lanny before we got on air that now you folks are incredibly busy. This is a time, a very unusual time, and not just in the economy at large, but particularly in the housing market and home building sector. And now clearly you are extremely busy looking at housing starts, number of units under construction, and home resale activity is and I'll go through all of this in just a moment. But thank you for being here today. What I plan to do is to give you an overview, kind of the general economic landscape in which the housing market is operates, our views on where we're at, and in this crazy time. And also where we think we're going over the next year, and kind of I'm tempted to say spoiler alert here. Things are gonna, the recovery and economic growth is going to continue, but now there's lots of little asterisks and caveats, especially over the last couple of weeks with a new variant that popped up around the world, and so clearly. It really highlights the fact that we're not out of this of the woods yet with respect to the pandemic, and also where the risks are still out there. With the pandemic, becoming a potential threat to the economy, but all of us at large. But really, I think there's significant progress that we've made, and I think it's worth acknowledging that progress. Let me just start my slide deck here, and it'll help kind of illustrate my what I'm saying, and also, I want to maybe start with had some. Okay, here we go. Hopefully you can all see this. And let me just start with like the hot topic. I would say probably was the hottest topic before Omicron showed up a couple of weeks ago, and which is inflation, which is in a way a sign of the time, in the sense that we've moved very, very quickly from a period of very hard recession, tough recession, the unemployment rate shooting up. And then once the recovery set in, we've moved very quickly through the various stages of the economic cycle, and now we're pushing. We look like we're in the late stages of an economic a cycle where you've got pressure building across the board, but well, not quite across the board. I mean, many parts of many sectors of the economy, which end up pushing inflation up. There's also obviously very kind of a COVID or a pandemic specific factors, and we'll be talking about the supply chain disruptions also contributing to that mix that's pushing up pressure. But clearly, after I would argue decades of not talking much about inflation, at least at the consumer level, now it's pretty much the number one topic of conversation. And on the latest numbers on inflation and for October showed that the rate of inflation was up 4.7%, which was the highest rate in 18 years. So clearly there's something there. Now, the big question is is it going to be just kind of a quickly passing phase? Are we going to go back to something closer to what central banks, but here in Canada, more specifically the Bank of Canada, is targeting, which is around 2%, which had been, as you can see from the chart there, the inflation has been kind of bouncing around that line for many years, but that departure here was not entirely unexpected, in the sense that the early stage of the pandemic, we had seen a number of the price for a number of things go down. Think of gasoline prices, but also there was a number of in the services, we had seen some price declines fairly significantly. So we did expect that inflation would kind of jump back up, simply on the basis of what economists call the base effect, when you compare it to a lower base a year ago, because the inflation rate is the rate of change relative to where the price of goods and services were a year ago. So we did expect a little bit of a bounce up at about this at roughly at this juncture. But clearly, most of us did not expect it would be that strong at 4.7% on a year-over-year basis. But when you dig a bit deeper into that number, it is in a way it's concentrated in a few items in that basket of goods and services, but also it's a little bit spread out into other component as well. Although those don't have quite as much of an impact overall. But really, the story is largely the fact that transportation costs have gone up, and even more specifically, it is that gasoline price increase that we've seen up until very, very recent weeks was a huge contributor to that increase in the consumer price index. But also a big contributor has been shelter. And that should be, when you think about it, a surprise to no one, considering how much home prices have gone up over the past year. And it's not just home prices, but it's also the rent as well in many parts of Canada. Rent that after a period where it had basically flatline, or even in some cases rent had gone down for a brief period of time in the early stage of the pandemic. So that those shelter costs moving up has been a huge contributor. And also food prices, and that this is where the story on supply chain disruptions also play a role. But when you think of shelter and food, when you ask the question that is this kind of a flare up in inflation? Is this just going to be a flash in the pan, and 6 months from now we'll be back to around 2%? These are the elements that are probably stickier in terms of inflation. So our view is that when you look at it from on a go-forward basis, we expect the inflation rate in Canada to continue to move up in the near term. So over the next few months, this is probably where we're going to see the peak in inflation and the inflation rate. But then a number of factors, including the base effect, are going to start to run their course. The rate of inflation is going to start to moderate, but it will not quickly snap back to 2%. Our view, because of things like shelter costs, or rising shelter costs and rising food prices, them being a little stickier, it's going to take a while for the overall inflation rate to converge back to 2%. So as you can see here on this chart, that's the dotted line here is our forecast, and you can see that we'll be converging overall in Canada towards that 2% only in the latter stages of 2023. So for those. The question I was asked not that long ago to the governor of the Bank of Canada is what is temporary, and his answer was it's not permanent. But it's going to be non-permanent, but it's going to stick around a little longer. So think of 2023 of the year where inflation is going to start converging back. So obviously this has implications on many levels. I'm sure as you in business, in the business world, thinking, well, okay, so it means like some of those input costs are going to go up, but also eventually this is going to be to lead to further pressure on wages, because workers will not want to lose out here on inflation and want to maintain their purchasing power. So clearly those are will contribute to sustaining that inflationary pressure a little bit longer. So that's one kind of one dimension of the implication of this. But of course, the other dimension is with respect to interest rates, because ultimately, when the Bank of Canada's mandate is to maintain stable inflation, and when you have inflation kind of spiking, it raises a question: is the Bank of Canada will it need to react very quickly to take control of inflation and bring it back to its target of 2%? And but in essence, the answer to this I guess question is about long-term inflation expectations. because ultimately there are many kind of transitory factors playing a role here. The Bank of Canada sees through these factors, and ultimately what it wants is to ensure that longer-term inflation, the longer-term inflation rate is going to, or expectation about those longer-term inflation does not get out of hands. So for those who were around in the 1980s up to the early 1990s will, I'm sure, clearly remember that at the time inflation was running hot, much higher even higher than what we're having now. And central banks, including our central bank here in Canada, had made it a mission to rein in those longer-term inflation expectations, and so they had to put in place a very tough medicine by raising interest rate for an extended period of time, which ultimately succeeded because we've been having stable inflation. It fluctuates a little bit from month to month, but really the trend has been pretty spot on 2% ever since, which is the desired effect on the economy is that it makes planning much easier. It is what is desirable or desired to have as from a macroeconomic policy perspective. And so the good news, at least that up until now, is that inflation expectations, although in the near term have gone up, but medium to longer term inflation expectations have not gone up that much. So this provides some room to maneuver here for the Bank of Canada to maintain interest rates as low as they are. The overnight rate is 0.25%, which in my book I round it to zero. And in fact, when you're factoring inflation, like the real interest rates are negative, which is extremely stimulative to the economy, which is what has been needed up until now to make sure that our economy recovers from the COVID recession. But the Bank of Canada is now starting to talk, and with good reason that they'll need to start to find an exit for that policy. And our view is that the Bank of Canada will start raising rates in the spring of 2022. So we're just pretty much around the corner. Before the middle of next year, we should start seeing the Bank of Canada raise interest rate. We expect 3 rate hikes over the course of 2022 and another 3 rate hikes in 2023, all of 0.25%. So bringing that 0.25% overnight rate where it is today to 1.75% by around the middle of 2023 or sometimes in the second half of 2023. Of course, getting the timing perfectly, and there's going to be potentially other factors that are going to play a role. I mean, it's a very imprecise science to make those forecasts. But really, the message is that this extremely stimulative interest rate policy is getting closer and closer to an end here. Not that the Bank of Canada will want to jack up interest rate very, very quickly, but the next stage is that interest rates will start rising progressively, but quite significantly over a period of a little more than a year and a half, somewhere a year and a half to maybe 2 years if we don't get the timing perfect. So that's really especially for those involved with housing, as we all know that interest rates are absolutely fundamental for the market, for the sector, and I'm sure everyone knows that exceptionally low interest rates have been a great stimulated demand significantly, especially over the past year. But even prior to that, interest rates were still historically low. We'd seen it had contributed to significant demand for housing. So that we're getting close to the tail end here of that big period with this huge kind of a tailwind here for the housing market. I'm spending a lot of time here because I think it's pretty fundamental in terms of when we think of 2022, how is it going to differ from 2021? Is that transition, that shift towards a interest rate regime that's not going to be quite as stimulative as it was up until now. Now, that being said, I mean, it's and the reason why the Bank of Canada is starting to signal that it's going to shift gears here is that now the economy continues to recover. We've seen significant progress since the summer of 2020. It has not been a smooth ride. We've had some bumps on the road here. Growth in the second quarter of this year, economic activity in fact contracted, but that was kind of short-lived. So that was just kind of a bump in the road. We've had a couple of weeks ago the numbers for the third quarter, which kind of reassured all of us that we're still back on track, back on the growth track. The economy grew at a rate of almost 5.5% on a quarterly annualized basis. So in other circumstances, that would be absolutely fantastic growth, but the numbers now have been so distorted by the pandemic that now 5.5% seems to be quite an okay kind of growth, but we're not. We're expecting more of that. Now, the bump on the road has a lot to do with the supply chain disruptions. They were especially a factor holding back the auto sector, but I would say manufacturing at large. I'm sure that for all of you in the building sector, exactly what I'm talking about. With my parts and still and on back ordered, or some materials that have gone harder to come by. Sometimes some weeks that things are improving, but other times that things are still difficult. So second quarter was quite an illustration of that. On top of that, we had at the time was still the third wave that prompted some provincial governments to reinstate some restrictions. So those kind of all happened over that period. But fortunately, with the vaccination, that proved to be really I would say a game changer in that respect. Once we've got vaccination across Canada moving up more much higher, much more quickly, when Canada kind of caught up with other countries. I was looking for, I know I have a chart coming on vaccination. But that really allowed, that high vaccination rate across Canada really allowed provincial authorities to lift increasingly or ease restriction that allowed the economic activity to not only to rebound, but also to broaden, to spread across sectors that had suffered significantly. And I'm speaking thinking more specifically about in the hospitality sector, for example, and restaurants and movie theaters and what have you, that were able to operate and not quite entirely normally, but more normally than up until then. So with that resumption of growth and the return to the broadening of growth as well, what we've seen is that we're getting close to full recovery in Canada. In fact, our forecast is that by the end of 2021, this is what you're looking at here, and in front of you is data up until the third quarter of 2021. So once we'll get the fourth quarter numbers, it'll show that Canada will be back, the economy, economic activity will be back to where it was pre-COVID. In the US, it's there already. So it means that the recovery phase will be pretty much done, and then we'll be entering the expansion phase. And I'm making here a distinction because once you get into the expansion phase, this is where you start to bump up against capacity constraint, and growth. The big numbers for growth are behind us at that point. You know, you've recovered some of the loss. Now you have to gain more and more based on, you know, boosting up capacity, and by boosting capacity, you need, you know, this is where you require obviously more labor, but also you require more investment in infrastructure and machinery and equipment and structures for the economy to start, you know, to accommodate that increased economic activity. So we're entering that phase. It means that the big numbers are going to start to look or the growth numbers are going to start to look smaller, but still decent. Now we're still talking here an economic growth in Canada of just under 4.5%, whereas in 2021 it was a little bit above 4.5%. But that's going to continue. If I were to show it to you on a quarter to quarter basis, is going to continue to slow down as we move towards 2023. Still, I would say it's still good. This is still fine. There will be challenges, but still fine. But and that's true across Canada. And I just want to point out it's also true in Manitoba as well. We've seen in 2021 a fairly robust, you know, rebound in activity, and in fact, we think that by now Manitoba's economy is pretty much back to where it was pre-COVID. So, you know, strong push again in 2022, but things are going to moderate, as you know, it is typical over the economic cycle. So slower growth. We're starting to bump into some capacity issue. I mentioned, you know, earlier in terms of structures, machinery, and equipment, but, you know, probably the best the best example right now is you know, those capacity issues in the labor market, and I'm sure you are being challenged right now by, you know, the labor shortages. And this is pretty much rampant across the country. It's more severe in some parts, like in BC and Quebec. You know, those businesses there are, or I should say, organizations there are facing those greater challenges there. But it's pretty much across the board, and the odds are we're gonna, you know, those challenges are going to get more and more difficult as the economy kind of continues to grow. Businesses will need more labor to operate and get that, you know, to get that growth in. So this is and we're likely to see some kind of a capacity constraint manifesting themselves on the other front as well. So that's part and parcel of being in the expansion phase of the economy. But I think really COVID threw like a few curveballs in the labor market, such that the job vacancy rates now have pretty much double relative to pre-COVID. So clearly there are some challenges there, and when you look at what in terms of the pool of labor, when you look at the pool of unemployed, things are going to continue to be quite difficult there in the sense that it's great for the for workers. Now there's many more opportunities out there. They're starting to see wage increases. But for employers, this is with an unemployment rate already down in Manitoba. It's now down to where it was pre-COVID. I think the unemployment rate is 5.7%. Was 5.7% just before COVID, and now in the month of October, it was back down to 5.7% again. And as you can see, our forecast is on a go-forward basis. So we're going to be back to stay around that level until the end of 2023. So well, that pool of unemployed is shrinking. So we'll have to get to find solutions to labor shortages somehow through retraining, making sure that those unemployed can have the skill set to fill those positions, but also it will require us to allow more people into the country, to increase immigration, which will help to a certain extent ease those issues. But in and of itself, immigration is unlikely to solve all those issues. The good news is that we've seen immigration start to come back. The easing of border restrictions that we've had over the last few months have helped. The government of Canada had started to boost permanent residents being offered even a little bit earlier by dipping into the pool of people who are already in Canada on a non-permanent basis. So those numbers, in fact, have been quite impressive. But really, in terms of the inflow of people coming in, this is more on a kind of a 2022, 2023 stories. We're expecting a significant increase in immigration. Canada's immigration targets have been up quite significantly. Now shooting over 400,000 this year and the coming two, so like 1.2 million in the space of 3 years, which would be one of the strongest, if not the strongest, immigration push that we've had. So in large part, this is to address those labor market issues. Of course, when we talk about immigration here, it has also a significant implication for the housing market, because we'll have to house those newcomers. And prior to the pandemic, immigration was a great source of housing demand across Canada, including in Manitoba. And so this, on a go-forward basis, this will now become once again a great source of housing demand that will require the building industry to respond. And in fact, we've already seen some great response here. Now, a quick word here on the housing market, and that's true across Canada, but no, it also is especially true in Manitoba. The pandemic has been absolutely crazy. After in a very brief period of activity dropping because of social distancing requirement, the market has bounced back, and with a vengeance, and such that so much so that at the start of this year we've reached record high levels, something that some clearly crazy numbers of for home resale activity. Things had cooled down through the spring and summer, although this fall we've seen an uptick again. Personally, I'm not convinced that this is the start of another leg up in the market. I think this is largely a reflection of expectations of interest rate rise around the corner. In fact, some mortgage rates have already, fixed rates, for example, have already moved up over the last couple months. which is maybe seen as a trigger for some buyers to lock in low rates and make a deal now to move up. So our view is still that the housing market is going to continue to cool in 2022, but remain the level of activity will continue to remain historically strong and quite possibly still above pre-COVID levels. So it'll be a cooling, but the market will not be cool. It'll still be hot. Hence my the title of my presentation: housing market. From red hot to just hot. And that's true. That's true of in Manitoba. Manitoba, that's now typically, and I'm sure y'all are familiar with the behavior of the market, which has always been one of the more kind of stable markets across Canada that doesn't have that as much volatility as in other parts of the country. And clearly, COVID has also been a trigger for a lot of activity. Part of it was the result of the exceptionally low interest rate. And when interest rates were cut early in the pandemic, it really kind of improved affordability, but also the pandemic kind of created new housing needs. People spent a lot of time in their homes and came to the conclusion that they needed to make some changes. They either did some renovations, like many Canadians have done and many Manitobans have done, but also it led many others to say, okay, we need to move. We need to now we can move to smaller markets because now work from home is working out generally quite well. In some cases, it's becoming kind of a permanent work arrangement. So it unleashed a very strong movement towards smaller markets, towards different parts of the country as well. And Manitoba has been a beneficiary of those trends. And we still expect those to remain kind of positive for the housing market, although most of that shift has taken place. Now, 2022 is more likely to be a period of kind of maturing in that kind of new post-COVID or still in COVID world. I'm not quite sure if we're post-COVID, but still this new world. Those trends are going to find some kind of right balance. So we might see a little bit less of demand coming from the very specifically from kind of a COVID churn. I like to refer it to. But still overall, the demand is still going to be very strong historically, but maybe not quite as strong as what we've seen in 2021. The big rise in prices that we've seen across Canada is definitely a factor in Manitoba as well. Here I'm showing Winnipeg, the home price index, the MLS home price index, that has spiked. And certainly the greatest spike in prices that the market has seen since 2008. And when you compare Winnipeg or Manitoba to other parts of the country, it's pretty much right there in the middle of the pack. It's been a bit more robust than other prairie markets in Alberta and Saskatchewan, where the prices start to go up there, but not as much as Winnipeg. But Winnipeg compares as being not quite as crazy as been in southern Ontario, parts of BC, or even some parts of Quebec as well, and some parts of Atlantic Canada, where we've seen tremendous price increase. So somewhere in the middle of the pack. Our view is that home prices will sort of moderate, but still be positive. So that when I say positive here is the prices will continue to rise in 2022, but not quite at the same rate that we've seen in 2021. implication of that is important to mention as well, is that now the big run up in prices will not be reversed. We do not expect prices to decline or reverse some of the gains that we've seen over the past year. So prices will continue to rise, but at a slower rate as demand cools a bit more. But also we're expecting that on the supply side, we're going to see a bit more supply coming to market in 2022. A big part of that spike in price, and that's true in Manitoba, it's true elsewhere as well, is that inventories are incredibly low. These are active listings as expressed in a number of home sales. They're incredibly low. Market is very, very tight. And so it's a competitive, if you're a buyer, it's incredibly competitive. You have to outbid the competition. So this will continue to be the case in the near term, although we do expect that markets are going to generally start to make their way toward a better balance between demand and supply. I'm not suggesting it will be perfectly balanced by the end of 2022, but we'll get a bit closer to that state later stages of 2022. Hence why we think that the price increases will moderate as we're getting into those types of dynamics. Now, low inventories on the existing home market, but also low inventories in the new build. So in the construction side, on the housing, home building side of things. These are recently completed but still unsold units, and as you can see, they're now exceptionally low. They weren't that high. I mean, those numbers look relatively speaking, maybe back in 2019 and a few years before that, they looked like they were a little bit higher. But really, when you consider you put it on scale to compare to other markets, they weren't that high. So it's just goes to tell you how low inventories are, and I'm sure all the home builders on the call right now can attest to that. There's very low inventories. Although that being said, I mean, builders are responding. There's great demand there. It's not that home builders are sitting idle and doing nothing. When you look at housing starts, they've been pretty robust over the last year. Here it's like kind of the average. What I'm showing here, because it's very volatile. So this is a six-month moving average, but it's historically very strong right now. It's been historically very strong over the past year on the new construction side of things. And when you look at homes under construction right now, they are basically, it's the biggest boom you have. I'm showing the history back to 2005, but you have to go back to the 1970s to have that kind of volume of the number of units under construction in the province. So clearly there is a supply response, a builder response to the great demand that's out there in the market. The thing is, housing starts take some time to result in a completion. So that to reach the stage that in the market people can actually move into those units. So that's why I say that in 2022 we should start now. Those like high levels of units under construction will start to generate more units that will come out of the construction pipeline and become completed and be part of the to address some of the great needs for housing right now. And that's true in Manitoba, but it's also true in across the country. So when I think of the housing market in Manitoba and why I'm still fairly quite bullish on the prospects for it, and one factor is that really is a big plus for the market, is that it's pretty it's pretty affordable when you compare it to other markets across Canada. And even I would argue historically, as you can see, this is our housing affordability measure, which is the homeownership cost as a percentage of median household income. So the higher the line, the less affordable owning a home is. And as you can see, that the current levels are pretty good. And this is obviously good for the home buyers right now looking to enter the market. But I think also from a demographic perspective, when you consider immigrants coming into Canada and looking for somewhere, making decision of where to start their life here, this is housing affordability. I think is going to more and more going to be right up there in their list of priorities. And also on an interprovincial migration basis, it may over time help retain more people to stay in the province, which is still a bit of a challenge for the province right now. It tends to lose more people than it gains from other parts of the country. But the maintenance of a fairly affordable housing market, I think, is going to be a big plus to attract and retain a talent which is very much needed from a labor market perspective. And so on the bullish on from a demographic perspective, from an affordability perspective, but also from a household balance sheet perspective, which prior when the COVID hit, we were very concerned about Canadian households being able to get through a severe recession because they were holding a lot of debt. They were very vulnerable. In fact, the Bank of Canada had been pointing to household debt as the number one vulnerability for the Canadian economy. And here we are today, with the economy now recovering significantly, with Canadian household arguably in aggregate in better shape than they were pre-COVID. Now, we still would expect that there's still going to be some tension, especially for some households that are still having a very difficult time. But in aggregate, Canadian, when you look at the delinquency rates, there are historically low. They haven't yet really started to come up. The debt mix has improved. The value of assets has significantly outpaced the liabilities, even though the debt mortgage debt has increased significantly in Canada. So that the picture is still pretty robust. And when you lay on top of that the fact that Canadians have accumulated a lot of savings, again, in aggregate, it's not everybody, but in aggregate, a lot of savings. So it really provides the Canadian household with a lot of still firepower to deploy on consumption, but also in an investment into housing, because a lot of that savings has gone to housing already. But this will continue to support many Canadians, Canadian households in their housing journey, and it will continue to provide some I guess strong demand for housing. So even though we're expecting a cooling due to higher interest rates, in particular, on a go-forward basis, we're not expecting a collapse in housing demand. There's still some fundamental factors that would sustain that demand. From a demographics, just to reiterate, I was talking earlier about immigration, but the fact that immigration is coming back will mean that Manitoba's population growth is going to pick up quite considerably in 2022, and really will even accelerate a little bit further in 2023 as more new Canadians come to the province. So those paint a fairly still a positive picture for the provincial housing market, which means that will continue to be strong demand for new housing. So we do expect that housing starts will stay historically high in 2022. They may come down a little bit from what we've seen in 2021. But nonetheless, I mean, to me, it's not a huge difference between 2021 and 2022. It's still very strong because the demand is there. There's going to be some strong, huge opportunities to continue to build in the year ahead for all the reasons I've already illustrated. Of course, this is in the context that we're assuming that we won't have to return to the restrictions from a pandemic. Our assumption is not that we're out of the woods in the pandemic, but we're probably out of the woods with respect to the more severe restrictions. Although Omicron that now is kind of has come on the table very recently, has the potential to change this. So this is obviously something that we'll continue to monitor very, very closely. And it's still too early to really have a good sense of what Omicron is about. Is going to be the worst possible thing, or could it be even potentially the best possible thing if it turns out to be a variant with that will have that poses less of a menace to health. And so some of the early words that we're hearing now is that it may not be quite as severe in terms of its impact on health, may not be quite as severe as some other variants. So this is still obviously something we'll want to, and we suggest that you monitor as well very closely. It could really have an impact of everything I've said up until now in terms of looking ahead in 2022 and beyond. We're not quite out of the pandemic yet, but if we're lucky, Omicron not being the worst possible scenario, I think we're pretty much on the right track on a go forward basis. So just to wrap things up very quickly, we're still reasonably bullish on the prospects for the economy. We're getting into the expansion phase now. Things are going to get a little bit more difficult to have big growth numbers, but it's growth nonetheless. There's going to be some challenges, especially in the labor market, but for the housing market, it's still going to be pretty strong. Prices are going to keep rising at a more moderate pace, but there's still some challenges out there and some risks out there to be mindful of. So just a quick plug here. I invite everyone to subscribe to our documents we put out on a daily basis. Lots of reports, analysis, forecasts that may be useful for your purposes on the economy at large, on the housing market. So I invite you to subscribe to our documents. There's lots of very, very useful information out there. So on this, I'm going to pause. I know I probably talked a lot more than I expected to talk. And I think I turn it back over to you, Lenny, or is that to Mahmoud?
Yeah, no, I can take it. Thank you, Robert. That was tremendous. But we do have time for questions. Hopefully we've got some. So I'll turn it over to Mahmoud to facilitate the Q&As. So go ahead, Mahmoud.
Thank you, Lenny. First of all, thank you so much, Robert. It was very insightful, and thank you for all the updates. There were a lot of questions that I was thinking of asking, but as we went forward, you answered most of my questions. So those of you who would like to ask a question, please sign into slido.com and the event code is 729282. It's on our screen, as well as the passcode is RBC123. So until the rest of the participants are posting their question, the first question that's up on the screen for us, Robert, is how much will the high immigration targets mitigate pressure on wages in Canada relative to other jurisdictions, specifically the US?
Yeah, like I said, this is part of the solution. I don't think higher immigration, at least in the near term, will alleviate wage pressure. I think, in fact, wage pressure in Canada have not, at least in the statistics, have not been that strong yet. We expect wage pressure to increase, like wages to rise faster in the coming months and year. Now, when you look at a little bit over the medium term, once we get more immigration in, it should reduce those pressure. But in the near term, I don't think it will be enough to counter the pressure that we'll see on wages.
Thank you. The second question has been, why hasn't anyone been talking about real price increases? As you say, inflation rate appears higher as it's comparing prices to a period of depressed prices.
Yeah, no, we are now more. It's more than just the base effect. I mean, the comparing to depressed prices of a year ago, I think we're getting out of there, and it's more than that. There are some clear pressure that have built, and I'm sure, again, everyone on the call here are seeing it firsthand in their daily operations, or even in life. I mean, just going to the grocery store, and so those are especially on the industrial side of things, will find a way. It's not a one-for-one like a transmission to the consumer level. There's always the margins that can compensate, because it's always more difficult to pass through price increases to consumers. But clearly pressure will be there to do so. And there's tons of anecdotes and tons of news out there that would corroborate that. You got retailers now facing with suppliers saying, look, we've got to increase the price of our products here, because now look, just the cost of a container from China to Canada has not just increased like 5-10%. I mean, they've gone up like 4- and 5-fold. Which is tremendous. So there are clear pressure out there on inflation. But that being said, many of those pressures, even the cost of containers, at some point they'll come down again, and may not be entirely to where they were pre-COVID, but they will not be sustained at $20,000 or $25,000 for a container, when pre-COVID it was around $2,000. So as the logistics chains start to operate a bit more normally, we're going to see those types of pressures ease as we move through 2022.
Thank you. This is my question: is how will the supply chain issue impact the housing market in the next 12 months, keeping in mind the higher interest rate environment?
Yeah, but I mean, I'm sure everyone on the call sees it. I mean, it's for builders in particular, there's tremendous pressure on their costs, and it makes the equation tougher. I mean, you have to deliver a product in a year's time, or whenever you're promising to deliver, and when you have costs that have been extremely volatile over the past year, it makes it very, very challenging. So I think it will materialize in higher prices for new housing, and we're seeing it already. Again, I want to stress that there are, and we've seen it with lumber, for example. Although lately, lumber prices are starting to go up again. There are some elements in there that will not be sustained at exceptionally high levels. Some of those equipment and material are going to come down in price again, maybe not all the way to where they were pre-COVID. So the intensity of those pressure is going to ease at some point. That we'll be able to also alleviate some of the pressures on new housing, like new builds, and a little bit down the road. But I'm not suggesting this is going to be the reality in 3 months or 6 months. This is a bit more further down the road.
Excellent, thank you. Another question is, does anyone track how much of the current home under construction or starts relate to baby boomers moving from family homes to other forms of housing?
Yeah, that's very difficult to track. There might be some consultants out there that have some a better sense of who's buying. I'll say in other markets, not sure as much in Manitoba, but in other markets, it's been a variety of buyers, including investors that have bought in kind of a new projects. This notion of baby boomers downsizing and going from big single detached home in the suburbs into some kind of a condo somewhere, maybe closer to downtown or elsewhere. It's not entirely, to put it this way, it's not entirely backed by the data. We're not seeing that much, but there's some of it, but it's much more broader. It's a fairly complex picture.
Okay, just a reminder, folks, if you still have any questions, slido.com, and the event code is 729282, and the passcode is RBC123. So the last question that I have is, how long will the baby boomers effect shape the market?
I would say the bigger impact, the bigger cohort right now impacting the housing market is the millennials. They have been huge in that shift. I was mentioning earlier this movement toward like suburbs and smaller markets, but for a lot of millennials, they are at the family forming stage of their life cycle. They had initially, they might have rented an apartment or had bought a condo in kind of the middle of urban areas. Now they want more space. They want space and live in communities that are more kid friendly, family friendly. And so it is that movement now that is driving that is probably the bigger force in the housing market. Those millennials looking for the housing that really meet their needs or where they are at their life stage.
Thank you, Robert. That brought us to our last question. So thank you so much for that. I would now like to hand it over to Lanny for any closing comments.
Thanks.
Thank you so much.
Thanks, Mahmoud. And Robert, thanks you once again for sharing your insight with us this morning. We really appreciate you spending the time briefing our members and sharing this information with us. It's been really insightful. Thank you to Michelle for hosting today's event for us on this platform, and thank you, Mahmoud, our Winnipeg rep here at RBC, in terms of the MHBA, for coordinating our session today. This has been fantastic. We really appreciate all of your support and your offer to do this for us. And thank you to everyone for attending this morning's session. We at the MHBA, we wish you all the best this holiday season. We look forward to seeing you again and hopefully again in person early in 2022. And until then, stay safe, everyone. Happy holidays and take care.
Thank you.